Hello, everybody. Welcome back to Darwin Investors. We've got another big show for you here today. Money Train Mike, joined by Jory and Magic Mike. And what we're going to do, we'll talk about what happened last week in the market, the week of review, what we expect to happen, or at least what we're hoping happens this week, because our money will be in there. We'll be talking about inflation, last week's Fed meeting, Omicron variant. And of course, we've had a rough week last week. I mean, I think we all know this. A rough week in the market last week. So we want to make sure that everybody's kind of calm and this kind of like look at the big picture and be able to talk about the basically things aren't as, at least in our opinion, at least in my opinion, not as bad as what they think. And as a matter of fact, we'll find that in the view of Wall Street investors, judging by bond rates and the Fed meeting notes, maybe not as bad as you might be seeing on mainstream media on these days. So how you doing there, Mike?
I'm doing great. How about yourself?
Not bad. Did this past week, did you have any interesting picks or anything like that, or did you make anything or lose anything, or
Well, I lost money this week. There's no doubt about it. I think it's almost impossible not to have lost this past week. You know, we had that sort of flip with the Fed when we all thought Jay Powell was a saint and helped us through it, but the market eventually, within 24 hours, changed its mind about whether what Powell was saying was good or not good. And so we now know that there's going to be rate hikes. We don't know if it's going to be 2 or 3, or whether they're going to lay off in the first meeting. We don't know that. However, the market now has decided that it would rather wait and see and to begin to trim. You know, everybody wants to own Coca-Cola now and General Mills, and nobody really wants to own some of the growth tech or even some of the high quality tech that has high PEs. People have started to trim those. For instance, notice how NVIDIA went from 325 to the 280s all in a few days. And it's
I noticed that.
Yeah, well, we all have it. We noticed that. And so my thinking is that we are on sort of thin ice right now. Based upon last week, stocks that I liked, like Lulu and Restoration Hardware, had good earnings, but not good enough. So, you know, that's one of the market themes. You have good earnings, it better be fantastic earnings with fantastic outlook, because otherwise it's going to go down. And so I think in the coming few weeks and then what's left of this year, there will be probably some bargains, but you have to be ready for it. You have to have some cash on the side to do that. And you have to have a shopping list. And hopefully you've ranked the ones that you'd want to buy. And my suggestion is to buy them slowly, because you might be wrong. You might be in the right stock, but the wrong time. So that's my thought.
So hold on a second. I'm writing some notes down here. I actually bought a Jerome Powell t-shirt after that Fed meeting. I was so happy. I made so much money on the day. I actually got the t-shirt with him looking like Jesus or something. And then you mentioned Lulu and Restoration Hardware and that sort of thing. And a lot of the retail stocks are getting beat up right now. Dick's, Best Buy, certainly the ones you mentioned, Foot Locker. I have my own theory, and you tell me what you guys think. So I think that basically with retail stocks, if you rewind a year ago, we had a situation where you couldn't get on airplanes, you couldn't go to football games, you couldn't go to concerts, and you getting stimulus checks. And basically the only thing you could do with this money was either save it, invest it in the stock market, or buy stuff. And very few people really, I mean, a lot of people that would watch this video are investing in the stock market, but most people just bought stuff with it. So I think what's happening is these retailers are basically reporting numbers and giving good guidance, and other people are like, yeah, well, I think we're going to go to concerts again, and we're going to spend our money a little bit differently than last year. And so we don't necessarily believe you're going to do better next year than last year. We think last year was like a a golden moment for you guys. You guys have any thoughts on that?
I think you're correct. I mean, if you look at using retail as an example, we didn't really have serious supply chain issues when these retailers were climbing up, but now we have it, and some are hit harder than others. And some of the premier retailers, for instance, let's take Target. Target is a premier retailer, but now Target is basically going back to its 6-month low. And it's had this sort of roller coaster ride, and it's gone down from 269 to 223 in less than a couple of months. That tells you that if Target is going down, there's going to be a problem in real types. There's one stock that has held up very well during that, and that's Costco. But Costco has not had some of the supply chains that others have, because they anticipated this, and they actually have leased their own ships and their containers, and they were really ahead of the game. And from my experience with Costco, having been an owner of Costco stock for over a couple of decades, it just seems to weather these kinds of things. And yeah, you can see that it's done very well. I mean, in a 52-week range, it's gone up about 75%.
Yeah, and you can see that Costco, it trades at a pretty rich valuation, a 4 PE of 40 or 39 and a PE of 48. They do tend to give that really nice dividend. I think it's like a special one time. We're talking like per share, like a $7 or $8 dividend per share. They do
Correct.
a lot of buybacks. So though their forward PE, the PE is high, but I think that a lot of investors, they think that this stock will buy back its own shares and eventually bring down the PE that way, just by taking some shares out of circulation. I'm going to put back in Target here. This was the original one you talked about, and Target is really, it's kind of like all the rest. Like if you look at Target, you look at Dick's, you look at the ones you said, Lulu, just like straight down. These are after earnings beats. That it's at a decent support right now, actually, but these are after earnings beats that RH's beat was massive, and this is the thanks it gets. Wham. Right back to, well, actually it's actually basically back to where it was before it reported, but this is, they're given fantastic guidance, they're given fantastic revenue, they're given fantastic earnings, operating margins like they've never had before. But it's like Wall Street doesn't believe them. They're like, you know what? Last year was a bellwether year. You're not gonna, this year will not be like that. We're betting that it's not. One of the things that you hit on was supply chain, and supply chain. Let me move this over. The supply chain is one of these things that was, as part of the COVID thing. And it had to do with, and I think it's part of what's bringing up inflation. If you think about what inflation is, what is inflation? It's when, when demand outstrips supply, right? And I think that here coming up, and the Fed seems to believe this as well, that here coming up, that our supply is certainly, now that people are coming back to work, our supply and our demand and we're not going to have as much demand, according to some of these retail stocks, right? We're doing things. I mean, people are going out. If you can see these college football games, you got people going to University of Michigan football games. I go to the airport, it's like really, really crowded. There were people killed getting into a concert not all that long ago. There's so many people jamming into concerts. So I mean, as morbid as an example as that is, but that's people getting out and doing stuff and not just sitting at home and buying and doing home renovations and that sort of thing. And so I think that the supply chain is going to loosen up, and I think that that's going to help bring down inflation. Like the demand is going to loosen up is essentially what I think. And that's what's going to bring inflation down, not interest rate hikes. If you look, this right here, this is the summary of economic projections from Jerome Powell and company at last Wednesday. You can look right here that they think the PCE inflation is going to go from 5.3% down to 2.6% next year. They're planning, it looks like, on 3 interest rate hikes, 0.3, this year. But I think that the money markets are saying that we might not get that many interest rate hikes provided this inflation comes under control. We see that we have really good GDP growth projected. We were 5.5 last year. Actually, I think it was higher, 6.5. And they're projecting 4.0 next year. With this sort of GDP and this sort of, if the inflation does come down and the supply chains do open up and the demand is less, and there's not as much liquidity in the market, they're not pumping a bunch of money in, is the Fed, you would think that they wouldn't need to do as many interest rate hikes. Do you think that the inflation is something that's going to stick around a bit, or what do you guys think? Is the inflation something that is transitory, as the Fed implies through its numbers, but not through its words, or do you think it's something that's going to stick around a while? What do you guys think?
Mike, I think it's going to last longer than Powell says. I think because when you look at supply chain, what does that really mean? Does it mean that we just can't get goods into our system? Does it mean that once they're here, we don't have enough drivers and trucks to distribute it? And the supply chain has many links in it right now. It's what's coming out of Far East. Are they going to get hit by the Omicron variant? Are they going to slow down? Are the shipping companies able to really keep up with demand because of the problem offloading at like Long Beach and the West Coast? Also, there's a shortage of drivers. There's a shortage of all kinds of things in the supply chain. So the supply chain is like a long train where there's some of the cars have been unhooked along the way, and we've got to have all the cars hooked to make it really function well. And I think it's going to last longer. I know these guys are experts at the Fed, but they've been wrong many times. So my thought is that it's going to take longer. I think inflation is going to stay with us a little bit longer. I think eventually it will be resolved. And there's another part of this chain that bothers me as a retired physician. The variant is doubling time is 2 days. Every 2 days, the number of people infected has doubled. And this is worldwide. It's not just here, it's worldwide. So what's going to happen, in my opinion, is that part of that chain is going to be broken by the number of people that get sick. Doesn't mean there's going to be more deaths with the variant. The Delta is more virulent than the Omicron, according to data today, but doesn't mean you're not going to get sick, and it doesn't mean you're going to be able to go to work. And hospitals are really vulnerable to this right now because we have tremendous fatigue in the hospitals. They're near full capacity, and they're going to be part of this chain that is going to face some big problems coming up. From my experience right now, the medical community is tired, very tired, with all the patients they're taking care of and a number of patients that are being turned away. People that have serious illnesses are being turned away because there's no beds for them. So I think that is part of the supply chain in a different way. What happens at, let's say, a Amazon warehouse distribution center where a third of the people get sick? That kind of thing. That's the kind of thing that I'm worried about for the next 2 to 4 weeks. And we'll get a real good view of this probably about in 2 weeks.
Yeah, we do. Sorry.
No, because I think that the news media, I think the news media is playing this down.
Oh, sorry about that. So, yeah, so I was looking at this. Yeah, you said about 2 to 4 weeks, and we do tend to fall about 2 to 4 weeks behind what appeared Europe, and then in the case of Delta, it was behind England in particular. And what we're finding in England, and this was just released, that they're getting a lot of new Omicron cases every single day, and that Omicron has actually taken over. Where are we at here? The spread of Omicron is now thought to be the dominant variant in England and Scotland, replacing Delta. And what we find is that their hospitalizations are up, as you say, right? It's taking out more people, though it's not as virulent. And so what we look at is, let's say only 1% of everybody that gets Omicron is hospitalized. Well, that's 60,000 hospitalizations if you have 6 million people. And if only 200,000 Delta folks are out there, but 15% are hospitalized, that's only 30,000 hospitalizations. Though their rate of hospitalization is much higher, but because there's far fewer of them, it requires less hospitalizations than the Omicron variant. And that's kind of what they're finding here with this, is that basically hospitalizations are going up in England. However, when you look at the number of deaths in England, it's very stable. So we're getting a lot of hospitalizations over there, not a lot of deaths. And one thing I think is really interesting is that if you look at this like inflection point that you have here, this to me is when Omicron and Delta are kind of blending together. But as Omicron takes over, the death number is trending downward. And that is what's going to happen, I believe, here in America. We're going to get this trend upward in deaths and certainly in hospitalizations. And we're eventually going to get an inflection point and then a trip downward. And I think that's when a lot of our recovery stocks are actually going to start to come to life again.
Oh, I agree. I agree with you.
And so
I guess for our investing audience, what I'm trying to say is that this is going to have an impact. Take your time in investing, have cash, and sort of wait to see what is happening. And in your favorite stocks, if they've gotten to a level that you feel comfortable, maybe take 25% of what you would normally put into that stock and put it in, and let's see what happens. And if you're willing to average down into it, so be it. Just take your time doing it, and pick stocks that have earnings, reasonable PEs, reasonable projections for the future. Some of those that we've talked about are getting there, are getting down to that price. I mean, NVIDIA, for instance, I think if it gets down into the 260 area, I think that is a reasonable place to begin to put some money into it. And so just have your target, but I can't see stocks rising like the normal Santa Claus rally, not right now.
Yeah, you reminded me of a point, and that's that you want to make sure that you're in certain, like you want to add to NVIDIA if you're at 260 is what you're saying,
right?
And I added to it last week at 280, and I'll show you guys how to do it. But what I did, I'll walk you through what I did last week. I want to get Jory's take on options and that sort of thing. About I'll talk about what I did last week and what I did or didn't make in the market. And so certain stocks are the types of stocks that if they drop, you want to add to them. You want to buy the dip on them. Certainly, if you bought the dip on Microsoft, right? And every time they dipped over the years, you bought the dip. I bought it here. You didn't have to buy it at the bottom. Let's just say you bought it here. You eventually did well. About here, you eventually did well. What if you buy it here? You're $10 above or $5 above where it is. History shows you're going to be fine, right? Buying the dip on Microsoft, even if you don't hit it perfectly. Certain stocks like this one, like Peloton, maybe you don't want to buy this dip. maybe, oh, it's dipped, it's cheaper, it'll come back up to $157 or whatever. But they're not all stocks are created equally. Let's see that. And you don't necessarily want to buy every dip. And then there's the one I did earlier this week. And then there's this one. This is kind of a tweener for me, Airbnb. And so you're never really going to catch stuff right at the bottom. So I bought Airbnb at 161. Now, I don't think that they're basically like they're down at 151. I guess they got down there. And I think briefly below 150 last week. They have a nice support level right around here, 155, and then another one looks like right here about 140. But they're one that even if they dip to 140, I'm not going to go buy more. They're kind of a tweener one. I'm not going to sell them like let's say I was in Peloton and it started to dip. I not only don't want to buy the dip, I'm just going to sell the stock and take the loss and say screw it. Microsoft, Nvidia, Apple, whatever, I'll buy the dip. And then Airbnb, what I'm going to do with this one, my thought is that basically they go up and down with the mood of viruses, it seems. Oh, virus is fine, let's go up. Pfizer comes out with something that says we can combat this, the stock gaps upwards. Oh, okay, Omicron, the stock goes down. And then somebody's going to come out with something and say, okay, everything's fine again, and then the stock will go back up again. Or their earnings are going to come out like last time and find out that their earnings were actually great. They don't have a PE at the moment, they have a forward PE, but their earnings were better than expected. And they don't have a high short float. They're not a heavily shorted stock. I think most people expect this to bounce back, though I'm not eager to buy a bunch more. You mentioned Nvidia. Last week, what I said I would do was I would buy Nvidia if it dipped to 280. And so here was what I did last week. I bought Nvidia. Let me see if I got a calculator here. I bought Nvidia at basically at 278 and at 281, and I got 50 shares. So it totaled this $14,016.63. And I divide that by 50 shares. So I essentially got it for $280 a share, which was the plan. That's what I wanted to do was to get it for about 280. But if you look at Nvidia and what I actually did, if you include all my options here, this is something Jory taught me. Basically, with the options here, my new price is 13,000 and 13,301. So right now my price per share is 280, but I actually made money last week, even though Nvidia is currently sitting at $278. I only paid $266 a share, and the way I did that was by selling puts. And so basically what I did was I sold the put here for 280. I sold it for 399, bought it back for 395. So I only made $5 there, but I thought I could get a better deal. Sold this one for 559, bought it back for 470. Sold this one for 699, bought it back for 450. Sold this one at 299. And look, they're all $280 strike puts that expired last Friday. Bought this one on the 16th, looks like, for 299, bought it back the next day for 190. And then on Friday, I sold this one for 374, bought it back for 236. And then I sold this one for 204. I was pretty active on Friday. 204, bought it back for 130. And sold this one for 109 and bought it back for 55. And all of that basically totaled to roughly $750, right? So I made about $750 last week in realized gains on Nvidia, even as I lost about $100 on Nvidia in unrealized gains. And I'll continue to sell puts on Nvidia and keep my strike price down. And I'll just continue making money this way. And if you make $700, it doesn't sound like that much, but if you do that every single week, that's $2,800 a month in money. And I don't mind owning Nvidia. So if you're going to sell a put, what that means is that if it finishes below 280, I will buy 100 shares. One contract is 100 shares. I will buy 100 shares of NVIDIA at 280, even if it finishes at 278, which in fact, it did finish at 278. So one of the things you see right now, it's at 278.01. So one of the things that with options is you want to take your profits. So I had a $280 put that I sold clear back here on the 13th. Oh, excuse me. On the 15th, I sold it for on the 13th, I sold it for $400, right? If I rode that to close, I would have made $400, but I would own 100 shares of NVIDIA because it's currently $278. But because I took my profits ahead of time, I made $750, and I did not buy 100 shares of NVIDIA. And this was something Jory taught me, is that when you're gonna do options, just take your profits. You know, a lot of people want that 90% profit, but you don't necessarily need that. What have you found, Jory, with options and that sort of thing?
I tend to play it pretty safely. I usually take my profits around 20%. Sometimes I'll hold out till 30%, but that's if we're in, you know, it feels like we're going to keep going up, which in this market it absolutely does not. I might even start playing a little bit more conservatively within the next few weeks. I might start taking my profits, you know, around 15% actually, because you know, it could be a little shaky, like we're discussing with the Omicron variant ramping up, and you know, just inflation and that in general. So, you know, it's better to be conservative with options because you unfortunately have that time decay ticking against you with options. So, you know, it's not like a stock where you can just buy and hold it and, you know, hopefully it goes back up to where it was. It's something that you buy, and you know, if it doesn't reach your price point, you know, by the time limit that is set, if you set it for 3 months out, or you know, whatever, some people go crazy and do a month, but you know, you'll end up losing. And so it's definitely best to play it safe with options.
Right. And you mentioned time decay, and that's why when I sell these options, I try to leave it as little bit of time as possible. I want the time on my side. If you're going to buy an option, you want it way out in advance, but if you're going to sell one, you want it, you want to make sure that you don't have much time to expiration. What do you make of this? So we had this sudden drop at the very end of the day. It had been happily scooting along above 280, and all of a sudden in the last 10 minutes it dropped to 278. What do you make of that, Jory? I know what I make of it.
Well, I mean, looks like it's just, you know, it's a stock that flew up really quickly, and looks like people are trying to sell it to me, but I'd like to hear your take on it.
Well, my take is that, you know, I don't want to say market manipulation, but let's face it, it happens, right? So here's what I think. I think somebody sold a lot of covered calls on NVIDIA, right? And NVIDIA just dropped off a cliff, right? And so at 350 is a 280, and then slam. And so what I think has happened is this, that there was a lot of covered calls out there. And a covered call basically says that if your stock is at a certain price, I will sell it to you for $280, right? That expired on Friday. So at 281, there was some big bank out there that said, look, I don't want to sell you my NVIDIA for $280 if it's sitting here at 281, right? So they quickly unloaded a bunch of shares and dropped this price down to the safe spot so that they could keep their shares and keep your premium all at the same time. And that's what I think happened, was that there was somebody out there holding an awful lot of covered calls and they wanted their NVIDIA shares. So for me, this is kind of a bull move for NVIDIA. Either way, I lost, since I have 50 shares, I bought them at roughly 280 and it's sitting at 278. I lost about $100, but because I was able to sell puts that expired on Friday, and then I was able to take quick profits, I made about, you know, $750 last week. And so that was a take on that. The other one that I did last week, and this one was a bit of a, now remember, these are unrealized gains. So I also went with Airbnb, and I can include options, but I didn't sell any options on this. and I got them for, geez, I don't know what this works out, about $165 a share. Airbnb is currently sitting at, where are they at? Oh, Airbnb stock at 157. So I'm down about 800, no, maybe about $700 on Airbnb so far. But these are unrealized gains. Airbnb is not the type of stock that I want it to dip to 139 so I can buy more. I'm not one of these people made of money that's just going to buy this thing all the way down to zero. Nor is it the sort of, but it's a company I believe in. I believe that business travel is never going to come back the way it did, but that consumer, just like regular pleasure travel, will be as ever. And Airbnb works in that space, in the pleasure travel space. But I'm not sure business travel comes on. I'm not as bullish on like Marriott's and that sort of thing, but I do like Airbnb. I think that they're a good company to kind of hang on to. Not that I'll hang on to. I mean, they might go up to about 210 and I'll put like a 5% trailing a stop and cut bait with these guys too. But not like an NVIDIA. NVIDIA I'm going to hold on to for a very long time. So what did you do last week, Jerry? Did you do anything?
Not a whole lot last week. Because it just, everything seems so unsteady right now. I've just been kind of holding off. I mean, as Mike said, it was kind of impossible not to lose money last week. I think I did as good a job as I could of preventing, huge losses. So I'm not worried about my portfolio at all. I think I'm in pretty safe stocks right now. Like, I added a little bit more to some Disney last week. And that's about it. The previous week, when I wasn't here, I had purchased a carrier call option with a $49 strike that expires next March, because I felt like that was a pretty safe.
How much you pay for that one?
That one, let me double check here. Let's see. So for the $49 strike, the price was, one contract was $7.90.
So you need to get to $56 by March, and it's sitting at 52. That seems like a pretty safe deal.
Yeah. So there's that one. But like I said, not doing a whole lot right now just because of how shaky and unsteady things are. But we'll keep keep an eye out for more dips to add some more stocks. I'm probably just going to work with stocks right now, just because, like I said, with options and time decay, it's a little shaky. So
the carrier seems like one of those that you add to a dip. Like if carrier dipped to $45, I'm all, I'm going to be all about carrier. It's not Peloton. It's not, oh gosh, some of these other high flyers that I'm not really sure will ever come back. It's more of a rubber ball than a falling knife. Yeah. Mike, what'd you do last week?
Yeah, I actually trimmed a lot of stocks that I felt had not gone up when the market went up, even though I liked the stocks that I liked that hadn't performed. Here's my thinking: if the market moves up and that stock doesn't move up, what happens when the market goes down? So I trimmed about 25% of my stocks that had that characteristic. I was willing to hang on to the Apple, the Microsoft, Costco, companies like that. But I also added to some stocks last week. I added to oil stocks like Chevron and Diamondback, only because I believe when the supply chain resolves, these companies are going to make money, and especially in the Chevron position, which it pays a dividend of about 4.6, and it's a very healthy company right now. And I'm willing to hold Chevron and add to it. And I did the same with Diamondback. Even though Diamondback has been as high as like 117 this year, it's now at 102. I think it's a reasonable buy. I also added to companies like I added to Nucor Steel. After it reported, it dropped from like 120 to 110. Just in a heartbeat, it dropped. But its PE is below 10. It had the best earnings it's ever had. It's the premier steel company in America. And the infrastructure bill has passed. So there's money for infrastructure. It's the number one maker of steel for cars, for pipes, for infrastructure. And it bounced back as soon as people sort of got the feeling. I mean, it bounced back up to 118 from 110 during the week. So I added to that. I added to Freeport McMoran. I added to United Rentals. So but I did not add to Apple. I did not add to Microsoft. I did not add to those. I just kept them. Did not add to Costco. I mean, for my way of thinking, they have to fall more. I did add some to Oracle, which had hit a new high at 103, but then there was the rumor out that it's going to buy Cerner information.
Yeah.
I've worked with Cerner in the medical field, and I'm not excited about the company. I don't think it's a great company, but that's my opinion. But I think Oracle is on a roll. I did add to Union Pacific. I did add to United Health Group. I did add to FedEx after it reported.
Yeah.
I think that's a reasonable buy. But when I say added, I didn't add a lot. I maybe added a total of 5 to 10% max into what I already have into the companies. So it was a small add.
So you sound like you're pretty bullish on the market if you're doing this much adding. So are you expecting a little bit of a Santa rally, or are just adding a little bit just in case, and you don't really think it's going to go that way, but you think that you want to have something there just in case it does, because you can't, you got no crystal ball. But
I think that there might be a mini Santa Claus rally, but I really think that once we get through the pandemic portion of the Omicron, I think the market will cool down. The market will say, hey, we're not going to shut down totally, and we'll probably be okay. Supply chain will probably improve some. I don't think the supply chain is going to improve fast. In fact, some of the car companies are saying they're not going to be able to meet the demand. They were saying first quarter, now they're saying the last quarter, and some are going to 2023. So they have a better feel on supply chain than you and I, because they're actually buying these products and trying to sell them. So,
right.
So,
Yeah.
I think you have to be a little bit bullish, but you have to be cautious.
Yeah, I tend to think that the market is going to go on a bit of a run here. We're looking at today is December 19th, and I think that basically we're about to get on. We're going to have down days too. Don't get me wrong, but I think that we're going to essentially here's when Apple reports earnings next. They report on January 26th. You look at when Microsoft reports earnings. They report on, I want to say probably about the same week, January 25th. So my feeling is that this market always seems to take some sort of make a bull run up through the big tech earnings. And I have a feeling we're going to hit a bull run sometime in the next, month anyway. And it's gonna go up suddenly. Not really sure exactly when it's going to happen, but when it happens, I want money in there. And the market it's a funny place for me personally, because I love playing the game, but I'm never truly happy. So when the market is way down and I'm losing unrealized gains, I'm not happy, but I put money in. And then when the market charges up, like I believe it will by say January 25th, January 26th, I'm going to be not happy still. I'll be like, oh gosh, it's huge. I need to sell off and wait for the next dip. I'm never truly thrilled to be in the market. It always seems like it's always sketchy in some way. At least that's the way it is for me. Are you guys ever totally comfortable in the market?
Never.
Yeah, I'm not comfortable. I want to make sure some people know that when the market really crunches down, when we have a meltdown like 2000, 1987, in mid 90s, blue chip stocks can fall 50% quickly. in 4 to 6 weeks, because I've owned stock when it did that. And the NASDAQ fell 60 to 70%. Even the leaders fell that far. So when I see companies today that are selling at PE, forward PEs that don't exist, but the market loves them, their stocks, I mean, they can act like the way Peloton acted. I mean, Peloton was 175 not that long ago.
Right.
In this year, now in the 40 range. So, it can happen. And so you have to be very cautious during these kinds of times, and just be careful. If you're going to need your money for something that you have to pay for this year, for 2022, let's say you have a balloon mortgage payment or something coming up, that money should not be in the market, in my opinion. That money should be somewhere where when it's time to pay that bill, you have it, because you can't depend on the market to provide you with that.
And that's scared money. I grew up in Las Vegas, and they'll say scared money never wins.
Yeah, and so
will lose.
So make sure you don't have that in the market, but have the stuff that you're willing to see it fluctuate up and down. And if you're a long-term investor, that's great, and to have some money to add to it. You never want to be 100% fully invested. That is a mistake I made many years ago. Kramer says you should have 15 to 20%. He says you should have 5% in cryptocurrency, 5% in gold. I think even differently. I think you should have a minimum of 30% cash on the sidelines, because if you do have a significant crunch, you will be able to get some real bargains. And also, if something comes up in your life, your water heater breaks, your roof develops a leak, you'll have money that you can take out of the market to fix that. So that's my own philosophy. I after the 2000 meltdown, I decided that I would not have less than 30% cash at any time. And there's been times when I've been as high as 100% cash. So,
and you hit on something earlier. You hit on something about the PE ratios, and in times where stuff crashes, if you know what you're doing, and if you know a company's value, and if you know their forward value, their forward PE, you can feel real comfortable adding to that position or just holding that position and weathering the storm. But like you said, you can't need that money anytime soon. And now this is a video that I plan on doing. I'll plan on showing people how to calculate growth. And so just to give you an idea, I went over here to NVIDIA, for instance, and you can go to their investor relations page, and you can pick up their latest. I thought I already had it queued up here. Sorry, guys. But you go to their investor relations page. Every company has an investor relations page, and you just find the latest 10Q from December 15th. Let's see here. Where are we at? Well, here'll be their November 22nd 10Q. And you can look and see their numbers, 9 months ended. You can see that NVIDIA had a massive run up last year from 11 billion in revenue to 19 billion. You can see that you can go in there and you can see their earnings per share went from $1.17 to 271 over 1 year. These guys they're like on the cutting edge of artificial intelligence, of cryptocurrency processing, gaming, autonomous driving. They're the leaders in GPUs and CPUs, but there's so much more than that. And I expect that this revenue will continue to grow in a really massive scale. And so what I did was I kind of looked at companies that have a PE that I looked at current companies, and I looked to see what I think it'll look like in the future, just based on growth projections. Now, just to give our viewers I know you guys know this, but just to give our viewers a quick review of what PE is. So basically, if you take the actual price of the stock, 323.8, and you divide that by the earnings per share, 8.94, you're going to get the PE of 36.2, right? If you take this number and divide it by that number, this PE, well, so the way a PEG ratio is supposed to work is that basically you divide 36.2 by 2.19 and just kind of find that they would, at least in the case of Microsoft, they would say that it's going to have 16.5% growth. But I don't think Charles Schwab, which is where this is, doesn't believe that. Charles Schwab thinks that they're going to have a lot less growth than that. They think that they're going to grow at about 2.8% this year. But anyway, I made a spreadsheet. So if you really ever want to, like, and I'm going to put out another video about how to look up investor relations and 10Qs and that sort of thing, about so you can project out on a stock and see if it's the kind of stock that you want. But Apple's is really bad by Schwab. They have a 1% growth, and there's a reason why they're looking at 1% growth. If you look at what Apple did this year, let me see, is it this one? Yeah, look at this wicked growth. It went from 260 billion in September of 19 to 274, so that's reasonable. From 274 to 365. And so nobody thinks that a mature company like Apple is going to go from 365 to like 480 or whatever. I think that Schwab's being generous by saying that they're even going to grow at all, if I'm honest. But if you look at what Schwab has done for Apple, they would say that Apple is going to have, let me see here, Apple's going to barely grow at all, right? They're giving them a 1%. So what I did was, just based on what I think is reasonable, I went ahead and just did price per share, just the way I did it. You know, price that it currently is divided by the earnings per share, which you can get off of their 10Qs, and then projected growth on top of their current earnings per share. So I said, if you did 50% growth on 484, it gets you here, 40% growth, you know, gets you there, and so on and so forth. Predicted that the 2025 PE on NVIDIA would be 26. The 2025 PE with a 10% annual growth on Apple would be a 20. The 2025 PE on Microsoft would be a 19.67. These guys buy back their stock often. Does Apple? They're always buying their stock back. I would expect that this is going to be some number lower than that. Microsoft, Mike, do they buy their stock back a lot?
Not really. They have,
so.
but not like Apple or some of these other companies that buy back a lot.
Yeah, Costco is always buying back.
Yeah.
So Microsoft, you might expect to be in the 20 range, and this is what Schwab has, is 16.5%. That's why I used it. And I was consistent and gave it every year, and said basically by 2025, the Microsoft PE would be like 19. So what this tells me is this: it tells me if these guys pull back, and even in the market crash, I'm comfortable putting more money in there, even in the worst of situations, because if everything comes back the way it should, their PE in 2025 should be roughly 20. It was Peter Lynch. He said that basically, like with the S&P 500, he used different numbers, but he basically would say that the S&P might be sitting at 400 points right now, or 4,700 points right now. He doesn't know whether the next 400 points will be down or the next 400 points will be up, but he does know that the next 4,700 points are going to be in the up direction. And I believe that. And so that's why I don't mind adding to these Microsofts and Apples and the ones that you know are good companies in dips, but I don't add to others, and I get rid of even others. For this week coming up, do you guys have anything that you have in mind coming up? I have something in mind. Would you like me to start?
Go ahead.
All right. So as we know, this is kind of my thing this week. Let me see where it is here. Here. Oh, this is the GDP rate, growth rate projected. Basically 6.5% annualized versus 2.1 last year. expected to grow 3.5%. But let's see here. I'm trying to bring up this right here. The NASDAQ 100 has got some new inductees this week, folks. We got next Monday, that's tomorrow, Palo Alto Networks will be added, Airbnb will be added, Fortinet will be added, Lucid, Zscaler, and Datadog. And a bunch of companies. Hey, there's your Cerner, Mike. That was being taken out of the NASDAQ 100, being sucked up by Oracle.
That's right.
But CDW is going to be out of there. Fox is going to be out of there. Cerner is going to be out of there. Checkpoint, Trip, and Insight. All those are going to be subtracted from the NASDAQ 100. Look for their stocks to dip tomorrow. Except for maybe Cerner's, who might go up on as an acquisition prospect. But the ones that are going to likely go up tomorrow, we've got Airbnb, we've got Lucid, Fortinet, Zscaler, Datadog, and Palo Alto. Of these, one of the reasons I'll admit I added Airbnb was because of the and Lucid. I added Lucid too. I'm bad that way. So I added Lucid and Airbnb because of this this addition to the NASDAQ 100. You know, there's gonna be a lot of companies out there that must buy these stocks. And I don't think they're in very good favor right now. And it's going to be a bitter pill, but they're going to have to buy them anyway. What do you guys think of some of these stocks and adding them?
On Airbnb, I think it's probably a good bet because I think in probably 2 to 3 months, the economy will, the people's desire to travel will increase as Omicron is spread through, and we realize that it's not going to kill you. It might make you sick, but it's not going to kill you.
Mm-hmm.
So that one should rise. People should be more comfortable renting homes and condos and apartments. I think that will be fine. I'm not so sure about Palo Alto. I think it's a great cybersecurity company, but also it does not have true earnings. It's a growth company. It's very highly priced. One hiccup along the way, and that stock could lose 20% in a week, maybe even in a day, depending on what it's for. In terms of those, I think that they're all reasonable, but they're like Zscaler is another one, which is expensive. It's a good cyber, but it's very expensive, just like Palo Alto. I would rather watch to see what happens with them than to be the first person in line to buy the ticket. That's the way I feel about those. One thing I was going to say when we were talking about Microsoft, NVIDIA, and all those companies that have been great growth on, if you look at like NVIDIA over a year's time, you'll see that peak to valley as it's climbing, it corrects 20 to 25% on the average from peak to valley every time it corrects over the year. Like in the beginning of the year, it started out at about $120, got up to 154, then corrected down to $120, got up to 160, corrected down to 140, got up to 204, corrected down to 175. So that has been going on for a year with them. So if you take that and say that their high was in that 340 level, it means that you're getting close to beginning to rebuy it if you don't own it or to add to it. If it gets down into the low 270s, high 260s, it's definitely a buy based upon its history. If you look at Microsoft, it doesn't have that kind of variation. It has a 10% variation from peak to valley, basically. So we're getting close to buying at Microsoft's historical peak to valley.
And those that pay attention to this sort of thing, that believe in this, would say that it actually that NVIDIA actually gapped up from 266 to 273, so that maybe needs to fill that gap. You were talking about valuation of some of these stocks. We're talking about Zscaler, Palo Alto, and just the cybersecurity stocks. And what we were talking about earnings, we're looking and seeing that they have no earnings. These are price to sales stocks, not price to earnings stocks. And if you go into their statement, you would see, this is for Zscaler, they made $673 million in sales last year. You will see that their market cap is $42 billion. So you would see that it's roughly trading at 70 times sales, which is very, very expensive. Just for context, a good growth company should only be about 10 times sales. A good growth company, by the way, like this one, folks, I can't go back to it. I'm going to buy them again, but they have $30 billion in sales, this DocuSign. And you know what? I might get an algorithm, and the algorithm is going to be how much I love DocuSign. But this year they're actually supposed to do 2 billion in sales, so they're trading at about 15 times. So if you compare that to a 70 times of Zscaler, we're talking about like a company that's much cheaper than Zscaler. I guess that's why Schwab gives this one a D and Zscaler gets an F, or actually did it. But Zscaler is trading at 70 times sales. No, it's got a C. Palo Alto, PANW, I believe it is. That one's trading. Now, this one is not as bad. This one's got a $52 billion market cap. Like you said, there's no earnings here. If you look at the sales, it's trading at they got 4.2, let's call it 4.2 with a 52 billion market cap. So it's trading at about 12, 13. So that's not awful, really. Palo Alto is the one cybersecurity stock, like you said. It's the one. That's why I get to see. It's the one that might be of those. If you're into those sorts of stocks, where you're into price and sales stocks at the moment, that might be the one to go after. Yeah. So I went ahead and I made a play for Lucid. I'm going to do Airbnb, and then I'm going to do Lucid, Airbnb, and then I'm going to continue selling puts on NVIDIA, because NVIDIA has got wild volatility, and the amount of money you can get from these, these stocks with high volatility, that's the reason why I'm able to sell these puts for so much money and cash out like several times a day. Is based on volatility. So I'm going to go with, I'm gone with Lucid. I already bought that. Airbnb, I'm going to sell Lucid at 50 bucks. At least I'll put a trailing stop on it. I'm thinking maybe 3% trailing stop is probably fine. 3% trailing stop on Lucid. Airbnb, I'm just going to hold that thing until it's over $200 because I'm convinced it'll get there again based on history. And I'm going to continue selling puts on NVIDIA. What are you guys doing for the upcoming week?
Well, for me, I'm going to continue buying. If they correct, I'll continue buying some of the blue chips that I like. I like Target. I like Union Pacific, United Health, MasterCard, UPS, FedEx, Oracle, Avago, Apple, Microsoft. I will buy those in small increments if they continue to correct. I'm not going to add any. I'm not going to buy, I should say, the winners of the pandemic. You know, the Zooms, and those companies, Pelotons. I'm going to stay with those. I also do not like companies like Roku. I think they're still very, very expensive.
Mm-hmm.
And PayPal, Square, Shopify, those will be good buys if they correct more.
Right. They're going to be like laggard, like they will pick up, but only if everything else picks up first. Like,
right. So that's my plan.
That's a fantastic plan. And you mentioned the Target. A lot of people like that one, and MasterCard. I have Visa, and I just love the valuation of those right now. Their profit margins are more than 50%. Oh, of every $1 Visa takes in, they make 50% of it as profit. And so I love those companies. I actually prefer them to PayPal and Square, the Visa MasterCard trade. What about you, Jory? What have you got going on this week? Anything?
I'm going to be following the same general idea as Mike's going with, probably just adding a little bit to just some of the safer, blue chip stocks as they continue to, go down a little bit. And then also just keeping my eye on those, those other stocks like, like we were mentioning, just ones that need to dip quite a bit further before I add to them. But I'll be keeping an eye on those for sure.
All right, folks. Well, that wraps up another episode of our Darwin Investors. Remember to like and subscribe and hit that little notification bell. Also, look for a coming video that we have on just to break down, to make you feel better when you're investing money in this market, that you're just not throwing money away. Look for a price to earnings growth video, price to earnings, price to sales, and how to value these stocks, and let you know, and so that you can sleep at night. So look for that from us. And with that, we bid you good day.
Good luck.
Good luck, everybody.